Are 401k loans good or bad? On this week's episode of Crap Now What, where we focus on moments where it's important to take a breath and start to look at some of our financial choices. Now, the spirit of this particular podcast is I am an untaxable retirement strategist. So I deal with people every day of the week that have 401ks, and I help them to untax those dollars. But we're going to look at 401ks today from a different angle. And this angle is going to be talking about something that is very popular, and it's the use of loans in a 401k. Now, what I want you to also know about this podcast is that this is about my opinions, my observations. Now, yes, I do have some history and experience and some background in this area. However, I am not providing these comments as specific financial advice, and everybody's situation is something that should be tailored and something that you should seek a professional before you make any decisions. And that's a very important distinction because many of you are just now finding this podcast, and some of you are my clients and new followers. And if this is another podcast that you're listening to, welcome back. If you've never listened to this podcast, I want you to understand that the spirit of this podcast is for you to be as informed as possible, or at least for me to take you down the path of information rather than leaving you uninformed. Because life does toss us some speed bumps, and we do have moments in time where we say, crap, now what? That said, I have a lot of notes here about this topic because 401k loans are very popular, and this is something that many people look into at least at some point in time. And how come we do this? 401k loans are something that nearly 1 in 3 people actually take out. And I want people to be as informed as possible about how important it is to understand the nature of a 401k loan. And part of the reason why people need to be informed is because there's a lot of hidden details in taking a 401k loan. It's something that you may not have even heard about when you approached the idea of taking a 401k or when you went to actually fill out the paperwork for a 401k loan. The paperwork might not fully disclose everything. HR might not be as knowledgeable. We've kind of gone into that sometimes this is maybe taken a little bit more lightly. And again, this is my opinion, maybe taken a little bit more lightly than it should be. How do people get to the stage where they need to consider taking a 401k loan? This is where the crap now what happens. Sometimes it's a big financial setback, and sometimes it's a smaller one. And the reason why I say this is that as I looked at some statistics for this particular episode, as early as August 9th, Market Watch of 2024, so just a few weeks ago, 66.2% of the households in our country, in the US, are saying that they're living paycheck to paycheck. Forbes ups that with a survey as early as or as recently as April 2nd of this year through a survey that was done by payroll.org that 78% of the households are living paycheck to paycheck. What is paycheck to paycheck? Paycheck to paycheck means that an individual or family's income barely covers essential living expenses. That's housing, utilities, groceries, transportation. And I think many people can identify with that, if not personally, but they know someone who is living in that lifestyle. And not necessarily always by choice, it's circumstances as well. So this is not something that is judgmental, it's more factual. Here's another statistic before we carry on. $100,000. $100,000 for many people is a significant salary, but more and more people are familiar with the idea that $100,000 in a household, whether it's single or family household, especially a family household, but even a single person household, $100,000 doesn't give us a lavish lifestyle anymore. And we've had some podcast episodes, and I invite you to go back to some of those. That type of dollars does not go as far as it used to. In Fortune magazine in June 2024, just a couple months ago, 48% of the households that were making $100,000 were also reporting that they were living paycheck to paycheck. So when 2/3, 3/4, even half of the $100,000 households are struggling to make ends meet for the bare essentials, then when something gets outside of that, the choices get fewer. We've talked about credit card debt, and we're not going to talk about that so much, but that bucket of money sitting in a 401k and the ability and the thought that could be a way to have a loan and borrow on my own money, sometimes, and to many, 1 in 3 401k accounts looks like a solution. Today, we're going to address this because it is not necessarily the ideal solution. Is it a myth? Is taking a 401k loan, borrowing on yourself, is that a myth or is it a hidden opportunity? I'm going to present some direction and some clarity to what a 401k loan really looks like. That's going to tell you with some facts about 401k loans that borrowing from oneself, is more of a myth. And if you want to go out and learn more, just Google and go to Investopedia.com, because most of these things that I'm going to share with you are from Investopedia.com. That's always a really good resource. It tends to be very black and white. It will sometimes address, in this case, why financial advisors will often say, well, yes, borrowing from yourself makes some sense compared to other options, but many will say, here's why you don't. Here's why it's alluring to look at a 401k loan. Because in most programs, and not all 401ks and the stipulations of a 401k and the guidelines are exactly the same. One can be a little bit different than the other. It all depends on how they've been created and the stipulations. But in general, most employers put together a similar plan to other places. The reason why it's alluring, a person, once they look at a 401k loan and they start to look at how much they could potentially take a loan on, it can be up to 50% of the vested dollars. Vested meaning the fund that would typically be available to you. And that loan can be paid out over 5 years. And there's low interest. So if you look at all of your options on where to pull money from, the ability to access 50% is attractive. A 5-year loan is attractive. Low interest compared to a bank loan, especially compared to credit cards, is very attractive. And the idea that you're paying interest to yourself is attractive. I'm going to hit you hard with some more facts about a 401k loan. Everybody knows that you have to repay the loan. You have no choice. Once you access funds from your 401k, you have no choice. You have to pay that money back. Just like contributions to a 401k come out payroll deduction, it's almost invisible as to how a 401k loan is paid back, because we don't always look at our pay stubs. We don't necessarily realize that the payroll deduction reflects the loan repayment and how that is actually being taxed. A contribution to a 401k is pre-tax dollars. That's part of the reason why we have ping points later paying for 401k rollouts, because we owe the government. Okay, that's the difference. A 401k loan, and I'm going to hit you really hard between the eyes because I'm going to guess that there's a very large percentage of people who don't realize that if they're paying back a 401k loan, that they're paying it back with after-tax dollars. And the reason we don't realize it is, like I said, we don't always understand or know or look at our pay stubs, especially now because most of it's online and it's not being handed to us as a piece of paper every week, 2 weeks, or once a month. Here's some other really hard facts about a 401k loan. You could, and in most cases, most 401ks are structured to not allow you to earn money on the dollars with the 401k when there's an outstanding loan. Here's another really hard fact. If you lose your job or change jobs, you still have to pay back the loan. And guess what? You have to pay it back in an accelerated schedule. We're going to dive into that one a little bit deeper. An accelerated schedule depends on how the plan is set up. But if you switch jobs or you lose your job and you have an outstanding loan on your 401k, you could owe that money and need to repay that money as early as 60 days after. There's some more details on that I'm going to share with you. If you fail to pay back that loan, then it becomes taxable. It's seen as a withdrawal and it becomes taxable and it can be penalized. Those are 3 very big points that I wanted to make sure that even if you don't listen to the rest of this podcast, where we go into a deeper dive on all of these, I want you to walk away from those. Because like I said, I'm very doubtful with all the people that I've talked to on a day-to-day basis, helping them to untax their 401ks going into retirement, how many people really understand these points, and they're very important. So as I mentioned, I went into a deeper dive into this. These are things that I'm very familiar with, but the resource on this is Investopedia. This is not my opinion. I am thoroughly breaking down what you can find on Investopedia.com. It's 8 things that you need to know about a 401k loan. So we're going to take a deeper dive into that. Let's take a deeper dive as to why you should consider not taking a loan from a 401k. The repayments of the loan will cost you more than the original contribution that you made to your 401k. Let me break this down for you. Back to the earlier point, the contributions go into the 401k pre-tax. That would be if it's a traditional 401k. It would differ if it's a Roth 401k. Roth is post-tax dollars. But if you look at a traditional 401k, the contributions are going in pre-tax. If you're repaying the loan with after-tax dollars, it's actually costing you more. For example, for every dollar that you work for and earn, if you're in a 17% tax bracket, effective tax bracket, then you're only having 83 cents to repay that loan. Every dollar that you make, 83 cents goes towards paying for the loan, which means then essentially you're paying 1/6 more than the original contribution that you made into your plan. Like I said, I got a lot of notes, so my notebook's going like this. Okay. The loan interest rate being lower than, like I said, bank and credit card, and being an attractive lower interest rate overlooks the fact that you're losing out on the opportunity to earn money on your 401k or portions of your 401k while you're having an outstanding loan. The part that you borrow for sure will not be, I shouldn't say for certain, the part that you have in an outstanding loan typically is not earning any interest or any type of return on it. Makes some sense. But again, that's not necessarily on our radar when we're looking at considering doing a 401k loan. So if your 401k earns 8% that particular year, then the actual cost of the missed dollars that would have been earned on the portion of the outstanding loan is actually an 8% interest. In most cases, if a person's gotten to the point where they're taking out a 401k loan, then most likely budget's gotten tight. And so in most cases, historically and statistically, people that have an outstanding 401k loan are also having trouble making additional contributions. So the actual cost of the loan is actually fighting against the contributions of and to the 401k and to the future. Also, your plan or a traditional 401k plan as it's set up might require that the dollars going back into or being deducted from your paycheck are actually going to the loan first, also handcuffing the future contributions. Also, and this is another one that's really a deterrent or should be a deterrent, also means that you can eventually lose more. So this is another really big one. If a person defaults on paying back their 401k loan, then it becomes immediately taxable. It's seen as a withdrawal. And if it's a withdrawal, then it becomes taxable as an ordinary tax income. And if you're under 59 and a half, you also pay the 10% penalty. So again, the hidden cost of a 401k loan can also be detrimental if a person gets to the point where the funds get so bad and the balance and the budget and everything gets so bad that there's also a default and there's also those hidden costs. Back to the quit or lose job. This resets the payment schedule. So let's say it's early on in a 4 or 5 year loan from the 401k, and those dollars need to be repaid. Heaven forbid you had $50,000 in a 401k and suddenly you owe the better part of 25,000 and you've lost your job or you've quit. The repayment schedule I mentioned could be as early as whatever the plan stipulates. It could be 60 days, but the federal government requires that 401k loan gets repaid at the end, by the end of that current year taxes. In that case, if it's not repaid by the end of that current year's taxes, then it does become and seen as a withdrawal, and you get taxed as ordinary income at whatever tax bracket you're at. Again, with the 10% penalty, if you're under 59 and a half. And so what happens is that a loan, an outstanding loan on your 401k can be prohibitive of you perhaps moving on to another company. You might end up feeling handcuffed to your current job because you have an outstanding loan. We're getting close to the end. We're at number 6 of 8. If you take a loan from your 401k, particularly if you take it for a life happens event, not a disaster. I know, and I work with people every day with 401ks. As I've mentioned before, and you're going to hear this over and over and over again, especially if you, and I welcome you, and I know I have a few new listeners this week, that there are people who take 401k loans. And again, this is not a Shaunelle judgment. I just am telling you, based on my experience and some of the people that I have talked to, there are people that take loans on their 401ks for car down payments, for other household expenses, perhaps even a remodel or something like that inside the household. There are people that I have known and clients that I've worked with who've mentioned that they have an outstanding loan on their 401k because they wanted to get cash out of it to help pay for a child's wedding. If, especially, and I'm not judging people, but if a person is taking out a loan from their 401k for something along those lines, then they're also dipping into funds that could potentially be there if there's a real bigger financial disaster. As a matter of fact, if you ever go and check my facts here with if you check my facts with Investopedia.com, they say if a person pushes the nuclear button for something that's not a true financial disaster, then they're blowing up their cushion for a real financial disaster. And you can check it. They use the word nuclear. If we're getting into those types of funds for something that's not a real disaster, then it also plays on to the next 2 points. And the next 2 points is that in this article and in this write-up is the idea that maybe if there's not the funds for some of these other things, then maybe there needs to be a hard look at household budgeting, the living beyond their means. Going back to some of the statistics that I shared about the large number, 2/3 at least, and in some cases, 3/4 of the households in our country are already living paycheck to paycheck, that it's a daily decision on spending habits. And just like almost anything, this is a whole human nature thing. Point 8 in this particular article that I referred to is that most people go into taking funds with the intent to repay it back on a faster schedule than what they can really do it on. And that's something that they found in surveys, that most people say, I'll pay back double, whatever. But again, kind of plays to this idea that maybe there's some personal budgeting, household budgeting that maybe needs to have a little bit harder look. That yes, our intentions are good, but look at what happened in the last few years out in the market and some different things like that with inflation taking off. There's more people scaling back rather than putting out. There are hardship withdrawals. So not everything's all doom and gloomy when it comes to the need to dip into 401k funds. There are such things, and even that's the case with Roth accounts, but we won't get into that too much since this focus is on 401ks. There are such reasons called hardship that the IRS allows to be removed and funds to be removed from a 401k. Now, there's a notable difference. This is not a 401k loan. This is a withdrawal. So if a person is applying for a hardship loan, this is money that's being taken out permanently from the 401k. And where the IRS comes in is if it qualifies as a true hardship, they will remove the 10% penalty if this person that's using the funds and withdrawing the funds is under 59 and a half. So a little bit of forgiveness, not a lot. It's not the easiest either, because 2 other things come into play. The employer and whoever is overseeing the 401k has to approve the hardship in the first place, and they're going to have their own guidelines on top of what the IRS has. Now, notice very clearly, I also said that it's a withdrawal. The funds are gone forever. A withdrawal gets taxed. gets taxed as ordinary income at the end of that tax year. So even if the IRS is forgiving that 10% penalty, what doesn't get forgiven are the taxes. Now, I'll give you a few examples of what can possibly qualify as a hardship. Extreme medical bills. That's probably not a surprise to most people. Unexpected funeral expenses might qualify as a hardship. In some cases, depending on the plan and depending on what the IRS has to say about the whole situation. Again, I'm not an expert, and everything that I've read and everything I know about this particular clause of hardship withdrawals is that there's a lot of depends, may not, will not necessarily qualify. So again, I very much want you to understand that this is not a quote at all, but these are some examples of things that might actually qualify, and that would be potentially higher education and potentially first-time home. Again, that goes a little bit counter to what we were talking about earlier with the loans, but this is a possibility, but that's really thin. It's really thin ice on any of the research that I did for those last two, the education and the first-time home. So what I want you to do, and I usually close each of these podcasts with this, the call to action on this is, I hope that you've listened to the largest portion of this particular podcast, because there's a lot of hidden things that a lot of people, I believe, do not know. And I want you to be as informed as possible. As we close this one up, what I want you to do is be serious about building up savings. Be informed about this particular option, possibly to be able to dip into this pot of funds. But I want you to be serious about saving money. Most people talk about the need to have at least 3 months of liquidity. That's hard to do, I get it. For most households, that's very hard to do. One of the tips that's out there is the pay yourself first. Take 10% right off the top as soon as you get your paycheck dropped in. If it's a $500 paycheck, take $50, throw it into savings, pretend you never saw it. Just like you're making contributions to your 401k, it get taken out, you don't even know, it's like invisible money taken out of your paycheck, make that invisible. I have guided people. I personally have a separate place where savings goes. It's not even in the same bank, because we can do things electronically and we can transfer instantly on our phones. Anyway, moving it from one place to the other, pretending it wasn't there, is what I would love to see you move towards. Budget for emergency funds and budget for items and big bills that are going to be coming up. Your mortgage and your car payment and those things usually come out of the daily budget. We know that. But then there are things like car insurance. If you're paying car insurance every 6 months, accrue the funds as if you're paying it every month and throw it into a separate account. Put some funds aside each month for medical bills. Put some money aside each month for weddings and some other things. Even $50 a month in a higher interest earning savings account. Like I said, bounce it from one bank to the other, put it into a higher interest account, and have those monies arm's length away so that it's starting to accrue, so that when that bill comes due, you can extract it from that bucket and put it into and pay immediately. Anything that's a big event should not really be a surprise, other than medical and disaster side. But other things that we know that are coming down the horizon, we should be starting to plan for that. If you have the opportunity to have an HSA with your employer, a health savings account, that can be something where a certain amount gets taken out of your paycheck every month. It gets accrued in an HSA. And then when there's medical bills and out of pocket and deductibles and things like that, those monies are already accrued. What's amazing to me is that 50% of the households, and I've used this statistics before, but I'm going to close with this, 50% of the households in our country have a net worth of $192,000. That's why so many people look at the runway towards retirement and are like going, crap, now what? Not only are they concerned that the dollars that they have are still going to be taxed on top of it, but they're going to run out of money in short order, maybe continue to need to work a part-time job. Social Security isn't enough to live on in most cases. And if you make a move to dip into your 401k and pull back on the amount of dollars for your future, that's not going to help the picture in the long run. If you like these tips and you think that this content is valuable, please subscribe, save it, share it with others, and please continue to follow this podcast. In most cases, a new episode is dropped on a Monday, every Monday. And the topics, as I said, are things that are very passionate about, helping you to be as informed as possible about different things that are out there, because our money is so tied to how we feel, our stress level, and to our future. I also have had and will continue to look at opportunities to share these concepts in workshop formats. And we will continue to work in that direction as well. But in the meantime, like I said, please share this, tune in, and also a huge thank you to the people that motivate me and inspire me to continually bring bigger and better and more relevant content. And that would be Michaela and Hans with Rin's Marketing, and then also Caleb with Sound Media. They're the team that keep me motivated to take the time to share the things that I know, and also believe in the idea that you should know as much as you possibly can. Thank you for joining us. Okay, so if you're still listening to this podcast at this stage, this is the boring stuff. This is the disclaimer. And I'm doing this because, yes, I do care about who you are and what you do with your money. And I'm going to be here to help give you some ideas. However, these are just ideas, they're theories. Sometimes these are ideas that are coming into my head based on what's going on in the world at this time. And they're not necessarily specific financial advice. I do encourage you, if you decide to do anything with your money, make any changes, seek the advice of a professional. You're welcome to follow up with me or with someone else, and make sure that what you're doing is something that fits with you, your lifestyle, your finances, and it's a strategy that's specific to you. Again, these are ideas and concepts. Do not necessarily take these as specific financial advice and follow it directly without having a full education.